Hi there, Salena Kulkarni here with another episode of the Alternative Investing Podcast. My mission is to help business owners build high-performance wealth that delivers reliable, predictable cash flow through unconventional strategies so they can fast-track their path to financial freedom. Each week I share with you the strategies, expert interviews, and real people's stories around the topic of wealth and financial freedom. And if you're a business owner who wants to learn more about financial freedom through alternative methods, please head over to my website, freedomwarrior.com.au, where you can access my library of articles, interviews, and programs to help you on your way to becoming more financially free. Hey guys, very excited to share with you an interview that I recently recorded with my good friend Tyrone Shum. Tyrone runs his own podcast, as many of you know, specifically which focuses on strategy and unpacking ideas that Australian investors can access in our market. The strategy that we unpack in this episode is all about syndications. From my perspective, syndications was one of the, I would say, amazing discoveries, because I love that you get to participate in real estate deals, but you don't have to do any of the day-to-day work or day-to-day management. They are very much the playground of the wealthy, generally speaking. But as it's a strategy that gets more and more exposure, I'm definitely seeing more and more people express an interest in it. For those of you who don't know me well, I think collaborating with others and building wealth as a collective can be super powerful for really amplifying your results. So anyway, I hope you enjoy this interview and connect with you in the near future.
All right, Salena, welcome back. I'm really excited to have you back on today. Today's topic is going to be about syndication, and I'm really interested to know a little bit more about this. So let's talk a little bit background behind syndication and how you came about these type of deals.
Yeah, look, syndications is something that I've known of and known about for years. Like, you know, obviously starting as an accountant, you heard it used as commonplace language and definitely around the topic of real estate. But it always seemed really elusive. Like, I never knew how to quite access the deals. And then the guys that had the deals, you know, you didn't really know them. And so syndications, you know, from my point of view, is a fabulous way to participate in real estate, where you can not only get access to exceptional deals, but as a collective, you can command all sorts of economies of scale. And the idea with syndications is you're focused on a single asset. And so there's a group of investors that come together and pool their money to try and, you know, get a bigger return in a shorter space of time.
I've actually heard of them for quite some time now, actually, and I haven't personally delved into any of these and been part of one of these. But it sounds like a great opportunity to get in, because if you've just got a small amount, but then there's a greater leverage in terms of getting a property with a group of investors as well. There's actually a greater upside. So what's been your experience since investing into these yourself?
Yeah, look, syndications is a really interesting strategy. And one of the great perks, I feel, is that you've got the ability to have direct security and access to leverage. But often these are deals that, number one, they only come across your table if you are part of a very small network of known, reliable deal makers. So as an average investor, you know, you or I probably wouldn't even, you know, we wouldn't even see these deals. Often they're, you know, transacted off market. And so for me, it's a great way to participate in very lucrative, elusive real estate deals as a passenger. And, you know, you don't have to worry about the day-to-day management of the project. You don't have to worry about managing any tenants. And at the same time, you get to participate as a, you know, in what would otherwise be a return that, you know, is the playground of the ultra wealthy.
I like the sound of that. So you've got a syndication that you've been involved in with over like 100 odd units here, which sounds amazing. And it seems like it's a great deal here. Tell us a little bit of background behind that one.
For me, with any real estate deal, but particularly with things like syndications, I think the most important decision to make before you even go in is, you know, who's the sponsor of the deal, who's running the deal. You know, do you know, like, and trust them? Have they got a proven track record? How do they manage? How do they communicate? So this particular deal that we're looking at here is someone that I've known for a while. has a stellar reputation, only works with investors within a referred small private circle. And because of his reputation in his world, he has access to opportunities which generally don't even hit the market. And so, what I love is that there's an opportunity to learn, to participate, and to kind of be witness to how the project is managed. And generally speaking, like typically these projects run from anywhere from 2 to 4 years, depending on, what the, outcome of the project is. But in this case, we're not talking about a ground up construction project. We're talking about the purchase of 112 units built in the 60s, already at 92% occupancy, but purchased but well below market value because of the fact that it was just a bit tired and poorly managed. So the thing that I love about the syndication strategy, the way that I do it, is I'm not looking to take on a whole lot of risk. And so you're going into the project and it's already cash flowing. Like that's the first part. So there's already a cash return to investors straight away. And then it's very clearly laid out in great detail in the documentation that comes with the deal what the plan is in terms of how they're going to create forced appreciation in that project. So for example, if the project is purchased for 4 million and they can see that the rents are below market value, they can see that the purchase price is well below market value, and that they can create anywhere from $2 to $4 million in forced appreciation, not capital growth and waiting for the market to go up, but in today's terms they can create that. Then there's so many different ways to look at it, but really what that does is it de-risks it. So there's syndications and there's syndications. Most of the syndications we're used to in Australia are really about ground up construction type projects. And, my experience is they can be incredibly lucrative. But from a risk point of view, if you put syndications on a risk spectrum, the sort of ones that I prefer sit sort of further down the lower risk end of the spectrum.
Mm. It's interesting to hear that, and I think it's really important that you've actually shared with us the differences between how these type of projects, for example, the development project where you go from ground up to investing into an existing one and the risks behind that. I probably want to explore that a little bit more in detail to understand and explain to the listeners as well the risks involved. So it's very we all, I myself am very conservative as well, and I don't usually like to take a lot of risk as well. But everyone has a different level of risk. How would you describe this to, say, investors and even myself, the level of risk that you determine in these type of projects?
Yeah, it's a really good question, and probably one that has lots of layers to it. But I'm a huge advocate of being good at doing due diligence in general as an investor. And I've got my own little, 5-star system that I've created in terms of like how I analyze deals. But ultimately, what I've come to realize is that, in our market, and it's definitely how I've created the bulk of my wealth. I've relied heavily, sorry, on a rising market. And that's great on one hand because it means there's no barriers to anyone being able to build wealth. It doesn't matter who you are, you can get in and you can use typical traditional property to ratchet up your net worth. But when it comes to these sorts of deals where I'm trying to create not only cash flow, but a reasonably good capital return as well, risk is all about the sorts of things that I sort of already mentioned, but like who's running the deal? What's their track record? What have they done when things go wrong? One of the things that's really important to me on a syndicated deal is they need to have multiple exit strategies. So, say, for example, there are less experienced syndicators out there who will kind of just be hanging their hat on one way of getting out. We're going to buy for this, we're going to sell for that, and it's going to happen at this point in time to this type of buyer. The more sophisticated, experienced syndicate operators will have multiple get out of the deal type scenarios. And, depending on the deal, they'll have all of that laid out for you. And they're exactly the sorts of questions that you should be asking as an investor. What if this? What if this goes wrong? What if, we have another shutdown with COVID? All those sorts of questions. You want to be asking those pointy questions up front. But from my point of view, what I like about this particular deal that we're looking at is I have purchased units effectively in a trust. So I have direct ownership of my share of the asset. I'm getting a cash flow return from day one. So there's no messing around. Like before I even commit the money to the project, I know exactly what the profit and loss for the apartment complex right now looks like. I can see that they've done detailed costings unit by unit. I know exactly what they're going to do. It's all pretty cosmetic stuff. There's nothing structural. I can see comparative sales for what this is going to be worth in today's market, not, whether the market goes up, great, don't care. Like I just know. And the thing is, when it comes to good real estate deals, and these guys, like this particular deal, one of the things I love about this operator is he knows to always leave profit in the deal for the next buyer. So let's say, for example, in this deal, the end value of the deal, if they renovated every single unit and did it to the highest degree was 8 million, they know to not take it up to that. They will bring it up to say 6, because if you take it all the way up to 8, there's no juice in the deal for the next person. So all of those little tactical nuances and, the way they think about how to structure these deals, they actually matter greatly. Most people will want to squeeze out all the profit for themselves and then just sell the asset at, retail price. Whereas these guys, they get that they're trying to leave some money on the table. So there's so many layers to this, but I think that risk is about understanding, what is your worst case scenario? What is your best case scenario? Can I live with that? Do I like how the deal is going to be run? What sort of communication am I going to get as an investor? What if everything turns to custard? What are my options?
It's so important to look at that, and I totally agree. It's any investment that we go into, we got to make sure that there's plenty of exit strategies, not just one or two, at least minimum 3 or 4, just in case things do go south. And if that's the case, then at least there's so many different ways we can actually back out. Because if you're not prepared for any of these, and touch wood, none of that does happen. But if it does happen, like pandemic just hits us or strikes us for whatever reason, at least we're well prepared and have already thought this out carefully, because otherwise when you're scrambling, usually a lot of mistakes happen as well too. What's really interesting that you mentioned was leaving a little bit on the table, because we're not dealing with just selling a home where there's attracting like a home buyer who's emotional. Obviously with that market, the residential market, you're buying maybe $1 million home and you've renovated and it's worth 1.5, for example. Those kind of buyers you're attracting from an emotional perspective, and they're going to be buying to live in for the rest of their life kind of thing. With these kind of things, this is a commercial transaction. So I can understand why you'd want to leave it for the next investor or the next business person or developer who wants to go in there and have a little bit additional gain at the end of it. But then if that is the case, then does that mean part of the deal, when you actually go into it, you don't get as maximum return as possible? Does that mean also it affects the return on investment as well?
Yeah, look, that is absolutely the case. I mean, if you could ride the deal all the way through to the finish line, you're obviously going to get a higher return. But I think the risk return balance constantly needs to be reviewed. For me personally, I would be happier with a larger pool of potential buyers selling at a discounted rate than trying to squeeze out another 2, 3, 4% return, but end up in a situation where my potential pool of purchases are small. And these guys that I work with, I mean, in my opinion, they are world-class investors. These are people who, there wouldn't be too many people within each of their niches that would do a better job than them. And so they're smart. They've been doing this for 30, 40 years. They recognize that greed is a terrible, emotion to have around investing, as is fear. And a lot of them will position their deals so that they are leaving profit in it for the next, whether we're talking about syndications or other types of deals. If you say, for example, sell an asset at 80 or 90% of its market value, then you're going to have way more people interested in buying it than if you try and, price it at top dollar. Like, for example, when we sell our homes, we always want top dollar. But, when you're thinking about the way that professional investors think, it's about de-risking. How do you reduce the risk on a deal?
It's a completely different mindset. This shift, because we're dealing with professionals here, and we're dealing with ongoing, I guess, sale of assets in the future rather than just a one-off kind of transactions, which is a different way of looking at it. So I'd like to probably unpack this a little bit more then, Salena. Let's go into the details more about this type of syndication. We mentioned it's 112 units. What was the story behind this? Like, why was the vendor wanting to sell? How did you find out about this deal through your source or your sponsor?
Yeah, so my trusted advisor or my deal maker that brought this to the table basically has a very long built network of real estate agents, funders, financiers. A lot of deals will come to him through the banks. Basically, the banks see that there's a property that's in distress and they will just take the deal to him to say, will you take this on? Other times, I mean, there's so many different avenues that but his due diligence process is considerable. So he will often look at a property and then spend a full month sending his entire team in to look under every nook and cranny before they make any. So the point I'm trying to make is before I even get to look at it, there's often 6 to 12 months of work that's gone into bringing that deal to the table. There is literally no stone unturned. They look at plumbing, they look at electrical, they quantify every single material that's going to be needed for every single unit, and they map out comprehensive, basically a business plan on how this is going to be managed. With this particular property, I have a feeling it came through a bank. This one I did a little while ago, so it came through a bank, and so it never went to market. And this particular trusted advisor is a known closer, like reliable, ethical, all of that sort of stuff, and has done a very good job in converting this from a fairly rundown, underutilized building to increasing rents across the board. It's fully optimized and sold at a premium.
Hmm. So basically, you go in as a syndication, as a group, say for example, to purchase say 112 units, and the exit strategy sounds like was to, once it's finished its renovations and so forth, leaving a little bit on the table, was to sell it back into the market again with an uplifted value.
Yeah, look, I mean, that's obviously the preferred strategy, but working with these guys, depending on the deal, there's often other strategies that are sort of put in parallel as, here's plan A, plan B, plan C, plan D. But effectively, the way that the plan gets rolled out, you kind of leave it to them day to day to work out, well, are you going to renovate unit 1 or unit 112 first? I don't care. The tenants are giving you grief about the rental increases. They manage that. From an aesthetics point of view, they've already worked out color combinations, materials, they're buying in bulk. You're getting the economies of scale there. But I genuinely love being witness to the process. It's not that I have any interest whatsoever in ever running one of these projects. I can't imagine anything worse. But I love that I've got that buffet of deal flow. So say, for example, even with this one guy on this particular deal, once the project comes to an end, like if I wanted to take my original capital and roll it back into another deal, there's usually within 3 to 4 weeks another deal to roll that money into if I wanted to. But that's the sort of caliber of person that we're sort of dealing with. Half a dozen deals kind of on the go, multiple teams running each project. Plenty of resources and capital to make sure the deal works properly.
And these are not small deals. I mean, what kind of numbers are we talking about behind that? For 112 units, I'm thinking in Australia terms, but is this actually in Australia or is this somewhere
No, so
overseas?
this one's actually in Atlanta, which is, for those of people who don't know, is sort of part of the Midwest belt of the States. And part of the reason I really like that as a geography is it is really boring, plain and vanilla. They're the sorts of places that you and I could live. They're not slums, but nor are they the blue chip high end of the market. These are basically working class areas, highly sought after, high rental demand, lots of energy gone into where is this located, why will this be a success, what's driving jobs growth, population growth, all that sort of economic and macro data that you would want when you get involved in these sorts of projects. But I've been to Atlanta several times, and it's just a very easy place to live. It's I really like it. So it's not ideal, but part of my thinking is, would I live there? What sort of people want to live there? Are they a problematic tenant, or are they someone who's just, are they families? Are they reasonable people? Are they going to pay their rent? those sorts of things.
Mm. And it's really, really good that you mentioned that. I mean, that's the thing with investing, we got to take the emotion out of it. And at the end of the day, if the numbers stack up, then obviously the cosmetics and the looks and stuff like that come at a later stage, especially when you're dealing with a very professional group of people. They will already know what to do. So we don't need to know about those details kind of things to be involved in it. But as long as the numbers stack up, I think that's probably the key aspect that I took away from that one that you've just mentioned. Can we unpack as well then the numbers behind this? Like,
Yeah.
why was it such a good investment for you?
Well, look, the numbers at a kind of a macro level were this was an asset that was getting purchased well below market value. There was bank leverage that was going to be applied to it. There was a limited amount of capital that was being raised by investors. I think that was about 2 million. The rest was all bank finance, and through that use of leverage, it was a pretty low loan to value ratio. They were going to create some forced appreciation and then resell within 3 years. The thing that excited me the most about this deal and most of the syndications that I personally invest in is the fact that they are cash flowing from day one. So before they do anything to this property was generating a 7% cash flow return for me. So I think there's a bit of faffing about in the first couple of months while they kind of get in and get the deal, under management. But from about the second or third month, I'm getting a cash flow based on existing conditions without, anything being touched. By the time they get to sort of the second and third year, they may have put up some rents, they may have, improved the building, but I know that my starting point is that 7%. Now, some deal makers will allow you to participate in the increased rental yield that they create, and others basically sort of just cap it and just say, well, it's going to be this amount for the term of the thing. The other component to the deal, so there's always two parts for the sort of syndications that I like. There's the cash flow part, and then there's the capital part. So in this particular deal, it was a 7% cash flow from day one, and then another 5 to 7% capital on the back end. Massive depreciation benefits, which are allowed to get passed on. And I think in the deal I'm showing you here, if you invested 200,000, you were getting 7% preferred return and a $91,000 depreciation write-off in the first year, which is just nutty. And I can't even tell you now, but the loopholes in that market are just outrageous. So on $200,000 invested, you got 91,000 write-off in year one. So let's say you've got a whole bunch of other investments that are happening. One of the reasons people like these deals is because you just basically end up paying virtually no tax. But I like the idea that you get cash flow and you get that appreciation kicker at the end. So the deal that I've most recently done, similar sort of thing. It was an 8% cash flow. And as the rents improved, that was going to probably creep up to a 10% cash return per annum. And then there was an additional 8 to 10% capital kicker at the end of the deal. And that was a slightly longer syndication. It was I think 3 to 4 year time frame estimate. And I think here's the thing, you really have to trust the person who's running the deal, because you have to trust their judgment on when is the right time to sell and who's the right person to sell to. And that's where it's not so much that you step back and you don't participate, but you have to really, this is where you have to have done your due diligence on the person selling the deal to make sure that they've, and they have skin in the game too. So it's, they have money on the table. So it's in their best interest to make sure that, it's a win-win for everyone.
Wow. It's amazing to be able to hear that. And it sounds like a fantastic opportunity because one, I want to just double check. Is that the 10% net? So it's gross. It's not gross though. It's everything's all taken out of it
Net,
already.
net.
Net.
Yeah,
Yeah, that's net.
after expenses, after taxes, blah, 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 it's 10% net.
Wow. So you can imagine compounding that every year. Like, I mean, not from them, but like, you receive that 10% income every year and you just reinvest it again and again every year back
Oh,
into, or even every month you're
absolutely.
receiving it.
Yeah, I mean, the thing that I kind of think about in my world is this concept of yield drag. So if you get offered a really high rate of return, you get your money back, and then you got to think, oh God, what am I going to do next? And then there's a block of time where your money's not working for you. When you work that out over time, it can end up actually reducing your rate of return considerably. And I've seen this with a lot of investors that I've worked with. They go into a local syndication here in Australia. They get offered what seems like a really good rate of return on their money. But then when it gets averaged out over a 2-year, 3-year timeline, because, the DA gets stuck in council or whatever, it ends up being the drag on that return ends up being quite considerable. So, the whole idea is, how do you keep your money working for you consistently? And so in my world, the idea of getting an 8 to 10% net return, you can do that easily all day long. To strive for some of those higher returns, yes, you can do it, but you often end up in situations where you end up with a yield drag. So I love that I can just consistently build predictable income and participate on the upside when there's a great deal without having to worry. Like, I like the idea of not having to turn my money over all the time. Like, I like the idea of having some short-term deals, some long-term deals, some mid-term deals. So, a syndication for me is maybe like a medium-term deal of 3 to 5 years. But I like that I don't have to worry about it. It's set and forget.
Yeah, and I think that's the great thing about it, because by the end of it, not only would you be receiving rental income, you'd also be receiving a capital increase. And has that been predicted or passed on to you at this point in time, knowing what's going to be at the end of it?
Yeah, so the way that a good syndicator will structure a deal is they will give you what they call a pref, a preferred return. So, say for example, in this particular deal, there's a 7% preferred return. What that means is, every year, before anybody else gets paid, before the deal maker gets paid, you as the investor will earn 7%. So that gives you a little bit of downside protection in terms of your return. Usually beyond that, the terms of how the profits and capital and income will be shared are all detailed in the memorandum, the offer memorandum up front. So from an investor point of view, what that does is it gives you peace of mind that more or less what you're going to get up front. So depending on how profitable the deal is, you might get a 7+5, so a 7% cash flow plus a 5% cap per annum. So that's a 12% return per annum. Other deals, it might be an 8+8, but every deal is different. Every deal maker is different. Sometimes, given the fact that people can't get a great return in the banks right now, there's a lot of capital out there looking for a home. And so, good deal makers have the luxury of being able to dictate terms. The better ones will make it favorable to the investor from a protection point of view. But, this is really, for example, in this deal, this is the culmination of 40 years of building the team, the network, and so forth. So depending on, who they are, you're not always going to have a variable outcome if there's huge upside. And you just have to, honestly, as an investor, you've just got to decide whether you can live with that or not.
Absolutely. Now I'm going to throw something in the works here just to make it a little bit more interesting.
Of course.
Let's say we compare this to, say, an Australian investment. Just go and buy a property and build a portfolio over, say, a 4-year period. If this is a 3-year deal, right? This one here.
This one, yeah.
So let's say we go and buy properties over a 3-year period. I guess what I'm really curious is, why would this one be a more ideal investment compared to going and just buy a property in Australia at this point in time?
There's no right or wrong with investing. There's only kind of a reference to opportunity cost, goals, and preferences. So there's no question at all that in a good, strong, stable market, Australian real estate will beat, in terms of a return on investment, will beat most other markets hands down. And so from the viewpoint of when you start off as an investor, you have to build capital. Like, unless you've got some massive inheritance sitting behind you, the goal has to be, how do I convert my surplus income into wealth? And there's no question that, investing in Australian real estate is the pathway. Like, you're not going to get the same degree of leverage or ratcheting up of net worth in any other asset class, including shares. And I can say that because I've been an avid share trader on and off at times, and I'm wholly property girl now. So you need to use Australian property to get yourself going and to build capital. So if you're an investor who's just starting out, you have to start there. The sorts of deals that we are talking about, they're not going to actually help you grow your wealth. However, my argument is that what Australian real estate is terrible for is cash flow. And so the question you have to ask yourself is, if you stick with the traditional model of wealth building, which let's say it's 30 years, over 30 years, you build a portfolio of assets, like I think you just said 3 or 7 years, like that's too short a time frame. You can't achieve crazy amounts of wealth in that. But to say 30 years, you do all the right things and you build a small portfolio, maybe you get somewhere between 4 and 15 properties, then really you've got to make a decision. Am I prepared to wait the 30 years for that portfolio to be throwing off the sort of cash flow that is meaningful to me, that I could live off? Or do I kind of want to get to the point where I've got a bit of capital to play with and then just take a small percentage of it and put it into these sorts of deals, like the deals that you and I love, Tyrone, and we can talk about that another time, but like, and just use that to immediately catapult the income side of it. So I'm not actually an advocate of all one or all the other. What I'm an advocate of is blending the best of both worlds to get the best result with the least amount of risk in the shortest period of time. And I think, unfortunately, in our market, the majority of wealth professionals are really biased towards different strategies and different investments. And I think if you're someone who's smart and you really have ambitions to get where you want to go sooner rather than later, maybe there's other things you want to do in life other than work or run a business, then I think you have to consider, how do I blend the best of everything to get the best result? If you compare this project with purchasing, real estate in the Australian market, it's kind of like comparing apples and oranges. The reason I go into this deal is I've got enough capital. More capital isn't going to change my life. What I need is cash flow. So I'm trying to take a small percentage of my capital here, and I still have my portfolio here, but how can I deploy some of my capital into these sorts of deals so that I can 5x my income?
Thank you. That's an awesome explanation, because what I think we'll do is, in a future episode, let's break down about the discussion, which we were just about to talk about, having that capital, but also deploying a percentage of that. It doesn't have to be everything, but, if you start that journey, and there's a few games that we've played in the past to do that, that actually, helps you understand that. So yeah, this is fantastic. Well, Salena, thank you so much for talking about syndications today. I think it's opened up a whole new world, and especially for a lot of investors out there who may not have even considered this, to look into it. So thank you so much for sharing that today.
Lovely to be here. Thanks, Tyrone. Thanks so much for listening to the Alternative Investing Podcast. If you're a business owner feeling frustrated that despite doing everything right in the property investing playbook and you're no closer to financial freedom, then head over to freedomwarrior.com.au to learn more about how you can use alternative investments to catapult your investing income and blend strategies to shave decades off your timeline to financial freedom. Till next time, take care. See you on the next episode, and bye for now.